Okay, ready? Yeah, so our today's agenda is to complete off Ind AS 12 and 41, na? Yeah. So Ind AS 12 and 41, these are the two things which we are going to deal with. Let's first start with Ind AS 12. The name of this standard is income taxes. Now, what are we going to deal in this income taxes? Why this standard? Basically, there is a paradigm shift with respect to accounting standard 22. Earlier we had AS 22, now here under Ind AS it is Ind AS 12. When it was AS 22, it was accounting for taxes on income and we had a profit and loss statement approach, whereas under Ind AS it is balance sheet approach. Of course, the inbuilt principle remains the same with respect to having deferred taxes. So why this standard? Then where does this standard deal with those areas? Some terms exclusively with respect to this standard: tax base for asset and liability. What is the impact of temporary differences, measurement. The seventh area, recognition and financial statement of current taxes and deferred taxes. Of course, one more area will cover, that is nothing but presentation. Yeah. So these are the areas which we are going to deal with income taxes. The objective, why this standard? Now what is happening normally in our country is, we earn in this year, but we may be taxed either in the coming years or some future years. Or it may happen that we may be taxed now, though our incomes and expense relate to future years as per accounts. There is always chances, because the tax authorities will tax us based on Income Tax Act. Whereas we find out profit and loss as per the generally accepted accounting principles, the Indian GAAP. We apply our accounting standards and find out what is the profit or loss. So the amount of profit or loss which is calculated by us and the amount of profit and loss which is calculated by the income tax authority, of course, is different. Now this difference is there, which obviously affects the tax payable in this year. But if you look over a period of time, you will find both of them are giving me same profit. Like the depreciation charge as per Income Tax Act is say 25%, and depreciation charge as per accounts is 10%. So what is going to happen is, in both the cases, whether it is tax records or as per accounts records, the amount of depreciation that will be debited to our profit and loss account will always be the same. Of course, over a period of time. Under accounts, I am going to debit the depreciation in 10 years. Under tax, I am going to debit the depreciation in 4 years. So what is happening is, if I look from a macro level, overall level, I will find the amount of taxable profit and amount of accounting profit is one and the same. But if I look on individual, period on period basis, it differs. Like if I am looking for 10 years, what is the accounting profit, what is taxable profit, I will find both of them are giving me the same results. Because in 10 years, the whole asset has been depreciated in the accounts as well as the whole asset has been depreciated in the tax. But when I look at the periods on individual basis, then I find the taxable profit and accounting profit differs. as a result of this difference, it may happen that in future there are some differences. Those differences are referred as temporary difference. We'll write it down everything. But because of these differences, what will happen? In future, I may end up paying more tax, or I may end up paying less tax because I may end up paying more tax today, and so on. This basically gives rise to deferred tax asset and deferred tax liability. So, what is the objective of this accounting standard? The basic objective of the standard is that the income tax be paid in the period in which corresponding revenue or expense are accounted. So, what I have to do is, I have to account for that income tax in the period in which the expense and revenue are getting recognized in the books of accounts. So, I can say Ind AS 12, what does it do? It establishes the principles for accounting for current tax, henceforth I will say CT only, current tax and future tax, which lies due to recovery of asset or of liability, asset or liability that are recognized in an entity statement of financial position, or you can just say balance sheet. The word statement of financial position is under IFRS, or I can say IAS, but here I can use the word balance sheet. Now see, this is what I spoke and this is what I have written. What is Ind AS 12 doing here? Nothing big, no big rocket science. It is just establishing the principle, when should you recognize current tax and deferred tax. Deferred tax are rising, why? Because due to settlement of a liability or due to realization of an asset. In future, the liability which is there in the books of accounts, in future the asset which is there in the books of accounts, that asset will be recovered and the liability will be settled. Obviously, it will have some tax consequences. Either tax would be payable or tax would be not refundable, recoverable. I would have paid more tax now, I pay less tax later. Yeah, so this is the basic main idea for this accounting standard, that let my user know that I am sitting on tax liabilities in future. Let me explain you an example. The depreciation charge in account is only 10 lakh. Depreciation charge in tax is 50 lakhs. Of course, next year ulta ho jayega, because the value of the asset does not go different. Whatever is the cost of the asset in accounts is the same cost for tax purpose also. So they charge 50 now, 10 later. In accounts I charge 10 now, 50 later. So what will happen? The moment I charge 10 rupees or 10 crores as depreciation in the accounts, my book profit is very high. And because tax people have charged depreciation based on 50, the taxable profit is less. So what happens is I pay less tax now, because amount of depreciation considered by the tax authority is more. So I pay less tax now. I pay less tax now. Can I say I will be paying more tax later? Because in the next year what is going to happen? In the next year my accounting income will charge depreciation of 50. The accounts books will have 50 depreciation, whereas in tax the depreciation allowed will be 10th. Obviously, in the future year, I have to pay more tax. This standard is identifying that area. That when the user looks here, like if I prepare my profit and loss account, some incomes would be there. The depreciation I would have charged is only 10. Based on that, can I say my net profit obviously will be higher? So now the tax what I pay, this tax is not based on this profit. The tax which I am paying, say 30% is not based on this profit. It is based on taxable profit. So what is happening is, here say for example even the profit is 50, I don't pay as per 50. I pay as per something which is reduced. But this gives an idea that it means that in future when this profit will be something, I will not be paying tax on that calculated profit, I will be paying on some other profit. This will lead to paying more tax in future, deferred tax liability, paying less tax in future, deferred tax asset. Yeah, just these are just accounting jargons. When I say deferred tax asset does not mean government is going to pay me money. Or when I say deferred tax liability, that doesn't mean I have to pay to the government. Okay, please say, you will never find a journal entry, deferred tax liability to bank. Neither you will find an entry, bank account debit to deferred tax asset. It originates in P&L, it reverses also in P&L. So it's P&L to DTL, DTL to P&L. DTA to P&L and P&L to DTA. What we are trying to establish is that in future, the amount of current tax will have an impact. What is going to have an impact is the current tax in future and not deferred taxes have to be paid. There is nothing like payment of deferred taxes and so on. Coming on to the second area. Yeah, so what is our second area? The scope. Now see, the name of the standard only gives me the scope. What is the name of the standard? Income tax. It means, can I say it covers taxes on income. Of course, domestic as well as foreign income. I earn from domestic as well as foreign sources. It also covers withholding taxes payable by a subsidiary, associate or a joint venture on distribution Now, can I say does not cover any kind of indirect taxes? Of course, not clearly mentioned, but indirect taxes don't find even your CDT, that is dividend distribution tax. Yeah, because that is not tax on income, it is tax on distribution. But if the subsidiary has distributed some profit and there is withholding tax, that is covered by this standard. What is not covered is DDT. Subsidiary pays DDT, that is not covered. But if the subsidiary has paid tax, withholding tax, TDS kind of stuff, then that is getting covered in this standard. Yeah. So basically on income. Yeah. Of course, earlier we used to say wealth tax, but now the concept of wealth tax is also not there. So not to write, but it excludes indirect taxes, DDT and so on. Now the most important part, our definitions. Now what do you mean by accounting profit? What is accounting profit? Very simple. Net profit calculated as per books of accounts before providing for tax expense. Of course, net profit or loss, I can say both of them. Net profit or loss computed as per books of accounts before providing for tax expense. There is nothing but, in a normal way we can say net profit before tax. So PBIT, that interest is removed off, depreciation is removed off, then whatever I gain, earnings before tax, that is nothing but we are talking about accounting profit, means what is there in our books of accounts. Then we say tax profit. Now see, you would be coming across profit and loss as per tax. That is memorandum in nature basically. The financial statements don't have profit and loss as per tax. In our financial statements, we have a balance sheet and we have a profit and loss which is as per books of accounts only. But only for tax purpose, we prepare a profit and loss for paying the amount of tax, for deciding the amount of tax. So that is nothing but tax profit. But I can say we prepare a P&L, but that P&L is memorandum in nature. When I say memorandum, means it is not part of my financial statements. It is not part of my accounting process. It is totally off the record. So that profit which is calculated, I can say net profit or loss as per Income Tax Act. Now, what is current tax? The amount of tax to be paid in the current year based on which profit? Accounting profit or tax profit? Tax profit. Very good. So, the amount of tax payable pertaining to current year based on tax profit. That is nothing but current tax. This is the most important definition, one of them, tax base. Right on the next page only. It is the amount attributable to an asset or liability for tax purpose. I need to talk something on tax base. I'll talk later. Just wait for some time. Let me write down all the definitions. Yeah, then we'll talk on tax base. As of now, just a bird eye view, what is a tax base? It is nothing but the amount of asset or liability, amount attributable to a particular asset or liability for tax purposes. Now, temporary difference. Some of you might be using the word timing difference. Of course, the word timing difference was for AS 22. Now, that word does not be valid under Ind AS. There is nothing like timing difference. We have only temporary difference. What is temporary difference? Difference between the carrying amount of an asset or a liability as per books of accounts and the tax base of that asset and liability. Very much important. I repeat once again. What is temporary difference? Temporary difference is nothing but difference between the carrying amount of an asset or a liability as per books of accounts and the tax base of that particular asset and liability. So, temporary difference is nothing but the difference between the carrying amount. Carrying amount means the amount at which the asset is carried in our books of accounts or the liability is carried. Carrying amount of an asset or liability in the balance sheet and its tax base. The difference between the carrying amount of an asset or liability in the balance sheet and its tax base. That is nothing but temporary difference. Now, because of this temporary difference, what happens? Just try to think in this. This is the reason for which in future I end up with paying more taxes, or I end up recovering some taxes which I have paid. Yeah. So, we get two more terms: taxable temporary differences and deductible temporary differences. Now, what is taxable temporary difference? This will, taxable means whatever temporary difference which will result in taxable amount in future when carrying amount of asset is recovered or liability is settled. Let me just talk on this first. Say for example, an asset is appearing in the books of accounts at 100. The same asset in the tax record is appearing at 70. Why? Because of difference in depreciation. The asset is appearing in the books of accounts at 100. In the tax it is appearing at 70. Now what is going to happen? The asset will be recovered. Recovered means what? I will try to get benefit from that asset. So can I say that asset is going to give me revenue? What is the benefit I am going to get from the recovery of the asset is 100. It will give me a revenue of 100, against which the tax people will allow me 70 of depreciation. So benefit of 100 will be received through an income, against which the tax people will allow me a depreciation of 70. So can I say at the end 30 is nothing but taxable amount, because my revenue in future is 100. How did I get to know my revenue is 100? The asset is going to give me benefits in form of revenue, because it is allocation of cost. So if 100 cost will be allocated, can I say revenue will also be there of 100, against which depreciation will be allowed as per tax, not as per accounts. As per tax, the depreciation will be 70 only. So I will be left out with 30. There is nothing but taxable amount in future. Taxable temporary differences. So 100 revenue, see, if you earn 100 revenue in accounts, there will be 100 revenue in tax also, against which deduction will be only of 70. So I will be ending up paying 30 rupees, pay tax. Same way, deductible temporary differences. You only explain what will be the, will result in deductible amount in future. Of course, I'll write down the same. When carrying amount, CA is carrying amount of asset is recovered and, or I can say, or liability is settled. The same example, just reverse it off. What will be the reversal? Asset is 70 in the books, asset is 100 in tax. It means the asset is going to give me benefit of what? 70 in future. The benefit of 70 in form of revenue will be received in future of 70, against which tax will allow me a depreciation of 100. It means, can I say 30 rupees is deductible in future? Of course, deductible amount in future. That is not tax effect. Its deductible amount in future is 30. I am going to get benefit of that 30 in future. Yeah, there is nothing but deductible temporary differences. So temporary differences can either be not taxable temporary differences or deductible temporary differences. If it is taxable temporary differences, it means somewhere I have to pay more in future. If it is deductible temporary differences, it means that I am going to get some tax benefit. Tax benefit not by way of refund or something like that. I would have paid more tax now. So the same will be adjusted later on. Deductible temporary differences. There comes deferred tax liability. What do you mean by deferred tax liability? These are the amount of income tax payable in future period in respect of taxable temporary difference. So we are linking here. What is a taxable temporary difference? Will result in taxable amount in future. Now because of this taxable amount in future, see the amount is taxable, will be taxed at some rate. That rate multiply by taxable temporary difference is deferred tax liability. So now tell me, what will be your deferred tax asset? Ulta, barobar ulta. What ulta? Can I say deferred tax asset are the amount recoverable in future period in respect of deductible temporary difference. Clear? And the last term, what is your tax expense? What is your tax expense? Nothing but it is aggregate of current tax and deferred tax. Current tax and deferred tax, no need to say add. Clear? Yeah. So these are the 10 terms we used, very simple. Accounting profit, the profit as per books of accounts. Tax profit, the profit calculated as per tax law. Current tax, what is current tax? The amount of tax payable as per the taxable profit. Thereafter we learn tax base. Now I have to speak more on tax base. I'll write down some, so for understanding purpose. What is the tax base? It is the amount attributable to that asset or a liability as per tax. Yeah. So it is an amount attributable to asset or liability for tax purpose. Temporary difference. What is temporary difference? Nothing but difference between the carrying amount of asset or a liability as per books of accounts and tax base. Then we had this temporary difference, we bifurcated into two parts. Taxable temporary differences and deductible. Don't say permanent. Taxable temporary differences and deductible temporary differences. What is taxable temporary differences? So we say will result in taxable amount in future. There will be some taxable amount in that order. Taxable deductible will result in future. Yeah. I had to explain you something more about this area. Tax base. We'll just extension of what we were learning. What is the tax base of an asset? The amount that will be deductible for tax purpose against any taxable economic benefits that will flow to the entity when it recovers the carrying value of the asset. I spoke on this earlier, but I am just writing if you read properly here. What do you mean by tax base of an asset? Can I say it is the amount that will be deductible for tax purposes against any tax benefits? Now this taxable economic benefits will come because of what? Because the asset is recovered or the liability is settled. If I am talking about a tax base of a liability, if I am talking about tax base of an asset, the asset will be recovered. And because this asset will be recovered, what will happen? My tax purpose, that amount would be deductible. For tax purpose, that amount will be deductible. Okay, like say for example, there's an books of accounts, I charge 20, under tax in 2 years only depreciation is charged, 50-50. So now can I say the carrying amount of that asset is 80 as per books? That's not to be considered. What has been, it is not to be thought of. The whole standard is now futuristic base. If you are having some idea with respect to AS 22, just remove it for Ind AS. Because for AS 22 you had income statement approach. Aaj kya hua? You should look in that manner. What is the tax base I can say? Can I say this 80 rupees का carrying amount है, मतलब उतना मेरे को future में 80 rupees will be the benefit even in the tax. What will be deductible? How much amount would be deductible under tax? Can I say under tax the amount will be 50? That is the tax base. They will allow how total is of 100. Out of that 100, they have already charged 50 depreciation. The left out. So I can just write down as a formula. Tax base of an asset equal to the carrying amount minus future taxable amount plus future deductible amount. I am not writing, so don't use that word. What will be the value of the asset in the tax? There is differentiate and as per books of accounts. Carrying amount. Look. What is the carrying? Carrying amount is 80. Yes or no? What is the future amount? Future में कितना tax भरना पड़ेगा? You will say, sir, I will get a benefit of 80 in any case. I am going to get a revenue of 80 plus against which the bare minimum benefit which I have is 80. Future taxable amount will be adjusted as depreciation. That is deductible. How much amount is the depreciation is nothing but 50. I am writing in a different way. What the amount of depreciation that I can charge is only 50. So my profit will get reduced by 50. In accounts, you may though charge depreciation of 80 because तुम्हारा carrying amount is 80. So in future, तुम depreciation you will charge 80, but in tax you will be allowed only 50. It means 30 rupees. That difference will be there. That is which difference? Deductible. Now just give me an idea with respect to tax base. Okay.